just going to get set up here. So I'm Candace Perko. I'm with Countryside Financial, and my business is specializing in acreage and rural financing. That is the core of what I do. If you have a property in the city of Calgary, I'm not your gal. But if you have some raw land, some farm, any acreages, rural communities, that's my niche market that I specialize in. My company has been around since 2008. I started my company myself. I realized shortly after I was licensed with RECA that there was definitely a need for some specialization in the financing for this line of work. There's a lot of different mortgage folks around there, and try as I might at the time when I was with a super broker, I just couldn't fill that need of trying to really specialize in this market with a larger sort of city brokerage, if you will. So that's where Countryside Financial started. It was to cater to exactly the business that you're all in as well. I recently joined up with a network in February, though, that I was able to access some different rates and a little bit of leverage. So I am officially licensed with Qantas, but my company remains to be Countryside Financial. So some of the things we're going to talk about today is what are really the differences between an urban and rural mortgage? The lending guidelines of rural and acreage and properties. What appraisal criteria do we use when we are mortgaging these properties? What conditions are placed on a rural mortgage? They can be quite different than the urban properties. The rural and acreage mortgage products available, there is different products available that are specific to acreage, rural, raw land, farm. What niche markets may you be able to access now with knowing this mortgage information that you have access to? Will that open up some additional markets for you? And why use a rural mortgage specialist for your business? What really is the difference? So the first difference in an urban property, so City of Calgary, the lender may not require an appraisal. Many lenders have auto valuation systems that they can use. So if you are in Mackenzie Town, and if the property is $350, as long as if the lender's AV system is between $300 and $400, it's just going to funnel through and that's fine. In a rural area, appraisal is almost always required. I say almost because there is exceptions to the rule. There's a few small communities. I'll use Redwood Meadows as an example. It's just on the west side of Calgary. It's a rural community, but there's enough there that you can compare an apple to an apple, and the lenders may let something like that go through the AV system. Now, the appraisals for rural properties are, of course, more costly than they are in the city as well. But most of the time, clients are well prepared for having to meet the appraisal condition. Now, the other difference between the two is the property being representative of the standard found in the community. So if you're dealing with an urban property in a city, the lender will want to know that the property that they're mortgaging on is representative of the greater community. If the average square footage is 2,000 square feet, they expect the property to be in that range. They don't want to lend on the 10,000 square foot property where the other properties are 1,300 or vice versa. You don't find that in a rural mortgage requirement at all. They expect acreages to really be all over the map. So there is really no definition for that from the lender's perspective that you would find with an urban property. In an urban property, there's no lot size restrictions. City lots are very standard, but you can have 0 lot size, and that's okay. A condo, as an example, has no additional size other than the property itself. An acreage size, however, really is a defining factor for a lot of mortgage lenders. Some mortgage lenders will lend on just 5 acres plus your house. Some will lend up to 15. Some will do a quarter section. Some will go up to 200. But it's that size of the acreage is really a defining value on the lender. And I'm sure that many of you have experienced having some sort of appraisal issues when the land value may have not been included with the mortgage person. The most prime and marketable property is 5 acres or less. So that's where you tend to see the lenders, a bulk of lenders will evaluate just the 5 acres because those are technically the most prime and marketable properties. And another item to note is that even if a lender will only value a certain amount of land, some lenders will not look at a file at all if it exceeds a certain cutoff. There is a few lenders out there that if your property is larger than 15 acres as an example, the lenders won't even look at it, never mind assigning no value. They just don't even want to see that file. They don't consider them prime and marketable at all. And the last difference really is just the water supply and the sewer or wastewater. In the city, of course, it's municipal, so that's very standard. For our rural properties, we could see well and septics, cisterns, that sort of thing. Again, that's a defining factor with a lot of lenders. They may allow, most don't have problems with well and septic. Some properties have no water whatsoever and rely on a cistern, trucked in water. Some lenders, again, won't look at those files, but for the most part, any water supply is okay with the acreage and the wastewater. Now, I'm not sure if anyone has seen these recently, but a while ago there used to be all the dugouts and the sloughs and the lagoons and that's how the water or the wastewater was being handled. Those are pretty much a deal breaker in this day and age. The lenders do not want to see those as the sole source of treating it. CMHC will, on a very strong file, still look at those, but that's a tricky one if anyone has those limits. And the good part with the lenders when they are doing underwriting the mortgages for the acreage in rural, the underwriters on those files tend to be more experienced. What you'll find is that the new underwriters at the mortgage lenders get put in the cookie cutter properties. That's where they start. The more experienced underwriters will be the ones doing our trickier files, which is the rural properties. So it's good for all of us that we don't necessarily, or from my perspective, we're not really dealing with the newbies, we're dealing with the more experienced ones. So the guidelines for the rural and acreage properties, they are house, garage, land. The lenders will look at the size of the property, the size of the house, your garage can be attached or detached, and then the land. The insurers will allow up to 40 acres of land for your valuation. So that's CMHC, Genworth, and Canada Guarantee. Though they will do a full appraisal up to the 40 acres. Yes?
If there is no garage, will they include a Quonset or another outbuilding?
They could. Very good question. If there is no garage whatsoever, the appraisers will usually make that allowance of including that as the garage.
And you're talking with CMHC and Genworth?
Not necessarily with it. With CMHC and Genworth, they control the appraisal process. So depending on who the appraiser is, some appraisers will say, no, that's just, there's no way that's a garage and I won't do it. But some say, well, that could quite feasibly be a garage and I do assign value to that. So not guaranteed when it's an insured file. If it's conventional, then we can control the process much more. Yeah. Yes, sir?
Well, outbuildings such as there's some pretty significant riding arenas, that sort of thing.
Exactly, yeah, and that's my next point, is that any outbuildings, corrals, barns, Quonsets, any of that, unfortunately, no value for a mortgage. And the reason is that, you know, the, not dictionary definition, but a mortgage is essentially, you know, a home. It's a roof over your head, and that's really it. So the lenders take the stance that it's not the mortgage's responsibility to pay for or to finance all of the extras that come with the property. Now those can be very costly. You know, a Quonset or an outbuilding or a fancy workshop can easily be a couple $100,000. So what we have to do with those files is get a bit creative on the financing side, whereas if a client, let's just say it's $1 million property, but the appraised value, which will only include, let's say it's $750. What we have to do is we are going to base the mortgage on the $750, so their down payment may be less. We may have to insure it because we need to use the cash between the $750 and the $1 million. So they will have to pay the sellers for the extra because that won't form part of the appraised value. Making sense? So, and now if it is a larger parcel of land, and it would be a conventional client, so the client does have 20% down payment or more, quite often it makes sense to insure a file just to be able to get the valuation on the larger land chunk. So if you're selling, say, 80 acres and a house, the buyer may be conventionally, they may not need insurance. They might have some substantial down payment. But for my end, I might say to that buyer, well, if I insure this with CMHC, then instead of just including house, garage, and 5 acres or 15 acres, if I insure it with CMHC, I can now include house, garage, and 40 acres. That will bring the appraised value that much higher, hopefully right up to what their purchase price is or close to it, and we can quite often get those files done that way. The premium on a conventional insured mortgage is 0.5%. So usually for a minimal amount of fee that's just rolled right into the mortgage, it's quite often can make a file work that may not have worked conventionally otherwise.
Are you saying CMHC will do up to 40 acres now?
Yes, they will, yeah. And Genworth as well, and Canada Guarantee, which is the new AIG. Yes, sir.
Do you work with other lenders or insurers, let's say Farm Corporation?
Farm Credit, BDC, yeah, absolutely. And that's where, if you're working with a financing person, whomever that may be, you want to make sure that they have those connections that if this is not a file that CIBC or TD, for an example, would look at, you want to make sure that that person has connections at credit unions, Farm Credit, BDC, Community Futures West. There's a whole lot of different players in this game outside of just the big five, and they all have some very unique products. Some of them are very aggressive to earn our business. So it's just a matter of being aware of all those, and we'll go through some of those today. So I'll just quickly finish up on the land portion here. So it is always house, garage, and the land is a variable. Some lenders are 5 acres and less. Some are 15 acres or less. Some will do up to a full quarter section, and there is one lender that will do up to 200 acres. And this is outside of Farm Credit, and this is just the traditional prime lenders, if you will. So the eligible properties that the mortgage lenders will consider, anything owner-occupied, of course, a principal residence is not a problem. Secondary residences are okay, so if it's a rental investment property, second home, anything like that, that's no problem. There's no difference in what the lenders will look at when it's rural versus urban property. The only difference would be if it is a second home and it is recreational resort, like if we're talking really rural that, only boat access or something like that, that may, that will ixnay a few different lenders out there, but there is still quite a few that would look at those files. The zoning on the properties can really be anything again. Country residential, rural, bare land condo, or agricultural are all okay. Agricultural is a bit of a wild card with some of the lenders. They will consider an ag zoning if there is no ag operations. So it can just be a zoning that may not have been changed yet or never had a reason to be changed if it was a family dividing title or something like that. As long as there's really no farming operation on that ag, we can usually still get that through. Many lenders have a guideline of properties located within 50 kilometers to a major center. Some have a guideline of within 20 kilometers, some are 35, but the average is 50. This is a guideline that pretty much every lender has, but almost all of them will exception. And what they just want to try and get rid of is they don't necessarily want to mortgage on those properties that really are out in the middle of nowhere, that has no comparable sales around, that sits on the market for years to try and sell. So it can be outside of a major center, that's no problem, as long as it's in a community that does have some sales. So not really just boonies, northern Alberta, nothing ever sells sort of area. As long as there is some comparable sales that have come up, don't even have to be within the last 90 days, or just has to be shown there's activity in that area, then we can get around that proximity to a metro area. And the terms and conditions that you would see on the lending guidelines, pretty standard right across the board. I'll go into more of the debt servicing and qualifying items later in the presentation, but there's really no difference between how a mortgage lender is going to qualify you for a rural property versus an urban property. The maximum mortgage amount is of course based on the purchase price or the appraised value, whichever is lower. So that goes back to what I was just talking about with how we can sometimes need to play the game of figuring it out, how we can maximize that appraised value if we know that it may come in less than the purchase price. And pretty much all mortgage products are available. There is exceptions as far as like a line of credit may not be available on a leasehold property, something like that. So there is exceptions to the rule, but for the most part, all fixed mortgage products, all variable mortgage products, all amortizations are available to all rural or acreage properties. So just continuing on with the lending guidelines, there is some ineligible properties. Now I'll just note that this is with the prime lenders. There is, again, some non-bank lenders, private lenders that we can still access, but just your sort of cookie cutter, if you will, mortgage lenders, there is some properties that are technically ineligible. So farming operations or land parcels that are larger than 200 acres. Many lenders will look at a file if it has limited farming operations on it, and those farming operations are not included in the income. So if Joe and Jane live on a farm, they might, have some cattle, they might have a little bit of farming operations, but as long as they're working in the city somewhere and that's the salary that we're using to qualify for the mortgage, that's okay. What we can't use is Joe and Jane's farming operation income, so the money that they're earning from their cattle or maybe their grain or what have you, we can't use that for the income. If we need to, if you are dealing on a true farm, then we need to access credit unions for that or farm credit, of course. But the big five and most of the non-bank lenders won't look at a farming operation, if you will. Vacant or raw land with no building commitment. Raw land can be financed, usually at about 50% loan to value. Some lenders will go up to 65. ATV used to go to 75, but they scaled that back a year or so ago. And what many lenders are doing now with raw land is they have a postal code system. So they'll go into their computer, they'll type in your postal code, and they will scale that. Again, it comes into the proximity to the next metro area. So the maximum loan to value may be 65%. Depending on where that postal code shakes out, it will scale it back. It could be 65, but it could be lower down. As an example, my office is in Bragg Creek. So Bragg Creek, Millerville, Pritis, sort of, a brush stroke right around Calgary, 65% no problem. Manton, Claresholm, getting a little bit farther west, you're down to about 55, 57%. And then the farther south you get again, you're a little bit closer to Lethbridge, so it goes up. So it just depends on where that property is actually located. Some lenders will lend if there's a building commitment. So if you are buying raw land, your client's buying raw land with a builder, with a building commitment that the builder is going to have the home built within 8 months, 12 months, that opens up the options for that person with a lot of lenders, because if there's a building commitment, then we have some more options with lenders. lenders will look at that. The options are fewer when it's truly raw land. So you're just buying a chunk of raw land. Maybe you have intentions to do something with it at some point, but at this point there's no building commitment and it's just truly raw. Non-conventional construction, the straw bale building, anything that's a little bit out there, CMHC has no problem with that stuff. Conventionally, those lenders aren't crazy about those files. Again, comes down to how strong that buyer is, how qualified that applicant is, versus kind of what cockamamie construction they might be up to and how that might play out. Not the end of the world if they are doing some sort of unique construction, but again, it'll just come down to how strong the overall file is. But CMHC will normally reinsure those files with no problem. Log homes always tend to be a tricky one. I really don't know why, but many lenders have a no log home policy. And it's something that I've questioned them about over and over again because there just doesn't really seem to be a good reason for it, but many have that policy. Wood foundations can be an issue. It depends on the age of the home, but quite often if it is a wood foundation, the lender will request a structural report on that foundation. Again, CMHC really doesn't care about that sort of thing. They may just let it go through unless it's quite a dated property. But conventionally, the lenders will almost always ask for some sort of structural report on that, which can be costly. Yeah, quite costly. And again, it comes back to, is this worthwhile doing conventionally? So I know maybe I'm not going to pay an insurance premium, but geez, I got to pay $600 for an appraisal, and it's going to be $2,000 for a structural report, and my home inspection's another $350. I might as well just pay the 0.5% insurance premium, and then perhaps that will, alleviate some of these costs and get it through. Any mortgage amortization has to be at least 5 years less than the economic life that's on the property. And private lease areas are pretty much a deal breaker for a lot of lenders. Even for the subprime guys, they're not crazy about these files. Crown land and government leases are okay. That's Redwood Meadows, Banff, some certain areas like that. That's not a problem. And again, just a quick tip. It's always about having all of the tools in your arsenal. Make sure you're working with financing people that know the properties that you are selling or your buyers are buying. Make sure your lawyers know these properties as well. If you are dealing with a lawyer or a financing person that doesn't understand all of this, you are going to waste your COF time as this person is sending this file around, seeing where it might stick, which is not advantageous for anybody.